Hello everyone, Chapter 13, Leverage and Capital Structure. This chapter we will learn capital structure theory, which is about the decision between debt and equity finance. What is the capital structure? It is defined as the percent of the debt and equity used to fund the firm's assets. As we saw in the previous chapter, the term leverage is simply use of debt in capital structure. The company may change its leverage without changing firm's asset for various reasons. It is called capital restructuring. The firm increases leverage by issuing debt and repurchasing outstanding shares, or decreases leverage by issuing new shares and retiring outstanding debt. So what is the objective of capital restructuring? The purpose should be always to maximize shareholders' wealth. More specifically, the firm wants to choose the capital structure that accomplish the goal of financial management, maximizing firm value and minimizing WACC. This is an example of capital restructuring. So suppose a firm does not currently have any leverage, called unlevered firms. The firm plans to increase leverage by borrowing half of the asset, here $4 million, and buy back $4 million stocks. So total asset remains the same, $8 million. If interest rate is 10%, then the firm should pay $400,000 interest every year. Let's assume that the share price is $20, then the number of shares outstanding should be 400,000 currently and 200,000 after restructuring. Compute ROE and EPS. The table shows a result with the three scenarios: expected, recession, and expansion. By different level of EBIT, 1 million, $500,000, and $1.5 million. With current capital structure, unlevered, in expected scenario, ROE is 12.5%, which is 1 million net income divided by the value of equity, $8 million. EPS is 250. Again, 1 million net income divided by 400,000 shares outstanding. In recession, ROE is 6.25% and EPS is $1.25. In expansion, ROE is 18.75% and EPS is $3.75. After restructuring, we should pay 400,000 interest, so net income in each scenario will decline by $400,000. Then in expected scenario, ROE is 15%, which is 600,000 net income divided by equity value, 4 million. EPS $3, again, 600,000 net income divided by 200,000 shares outstanding. In recession, ROE is 2.5%, and EPS is 50 cents. In expansion, ROE is 27.5%, and EPS is $5.50. From this example, we find these. The variability in both ROE and EPS increases when financial leverage is increased. For ROE, current range is from 6.25% to 18.75%. The range increased from 2.5 to 27.5% with capital restructuring. Same trend is found in EPS. What does it mean? It means that the volatility of future cash flows will increase if leverage increases. So, highly levered firms are generally riskier. We can find break-even EBIT, which makes both capital structure indifferent. Let's find EBIT that makes both EPS same. Current EPS is EBIT divided by 400,000, current number of shares. After restructuring, EPS is new net income, EBIT minus interest expense generated from the leverage, 400,000 divided by new number of shares outstanding, 200,000. If you solve this problem, break-even EBIT is $800,000. With $800,000 EBIT, EPS is $2 for both situations. This tells us that the effect of the leverage depends on EBIT. When EBIT is higher, leverage is beneficial. If we expect EBIT to be greater than the break-even point, then leverage is beneficial to our stockholders. If we expect EBIT to be less than the break-even point, then the leverage is detrimental to our stockholders. Shareholders are exposed to more risk with more leverage. ROE and EPS are more sensitive to change in EBIT. Package 1. A firm currently uses no debt financing and plan to increase debt by $1 million. The interest rate on the debt will be 9%. The firm has 200,000 shares outstanding, and the price per share is $20. Ignoring taxes, find break-even EBIT. To find break-even EBIT, let's find EPS for each case. With current capital structure, EPS is simply EBIT divided by 200,000. After restructuring, interest expense will be generated by 9% of debt, 1 million times 9%, $90,000. So, numerator is EBIT minus $90,000. And since the firm will repurchase the shares by $1 million, it will buy back 50,000 shares since current price is $20. So the denominator is new number of shares outstanding, 200,000 minus 50,000 equals 250,000. Solving this equation, if it equals to 300, and break-even EBIT equals to $360,000. Now, for investors' perspective, should investors always try to find the companies with the right level of the leverage which satisfies investors' needs? The answer is no. An investor can freely make his own leverage using the personal loan, called homemade leverage. Suppose an investor wants to increase the risk to the level of the proposed capital structure in our previous example. Even though the firm may choose not to change its leverage, investor can borrow $2,000 personal loan and invest. Then since investor should pay interest, that earnings will change to the same level of the company with capital restructuring as shown in the table. This example tells us that investors always can increase leverage themselves to create different patterns of payoffs. So, firm's decision does not make any differences to shareholders. This is the end of the first part. Next part, we will see optimal capital structure theory.